Welcome to TradeTheMBI.com. This is John. This report is for the 23rd of January and new highs. Continuing the bull move, a little bit more of a short increase activity on the MBI white. Not significant at this particular stage. Signs still under red, and the green DOC is above red DOC as well. Short-term buyers fading off just a mention here at the start, not relevant at this particular stage. We're still on all positive extremes, so yes, that's all going to get moved back. But again, it's just an indication that in the muck of readings that are coming through from economic data, soft but not horrible. So in that space, where else are you going to go with your money? But in the market at this particular stage, certainly not moving to treasuries at this point, given the chaos going on there. So just continues to fuel it now. Is it justified? Well, everyone is going to debate those situations, but I think as long as you have the devaluation of dollar situation, the continued money printing, the market has to go up to accommodate that, irrespective of what earnings in that are. From a treasury standpoint, we moved off the ridiculous, but still elevated relative to where current rates are versus where treasuries are yielding. So there's the discrepancy there. Though the idea of rate cuts is starting to fade in a lot of bond traders' minds as we see the mixed data. And then we got this coming out of oil, slight spike, not critical, but going definitely in the wrong direction vis-a-vis wanting to give the Fed the latitude to ease things. Literally needed to be moving below that 70 into the 60 range. Now you're at the halfway point to 80, and I think at 80 you start to have more problems with inflationary pressures, and that's just a real world situation. That's only going to put added pressure on the Fed to hold things before doing anything. And if there's still activity that's supportive, which at this particular stage there is, everyone's talking about the impending layoffs and that. And I think that, we've talked about this. The middle lower side of the economic scale is definitely going to be hurt by all of the situation, but when isn't that the case? So that's been a usual. Euro stabilizing right here at that 110 range. We already know the euro's way out of whack given the relative strength of the eurozone at this particular stage, but uh, neither here nor there. It is what it is. We just follow the readings as they go. Gold, holding on a little bit, which was impressive compared to crypto, and not a shock here. We're filling down towards this last positive extreme, which we talked about before, was in the 39 range. We still have MBI white leading, so there was nothing for a recovery. It was just a question of whether or not that rising steel would be enough to help support things, and really didn't do a whole lot of anything as mid-term, long-term buyers just completely fading out. And this is just the reset from the exuberance of the ETF, that excitement all going down, and sets up a new cycle for when there's the final approval, and that changes the entire world for crypto. Which is the narrative. It doesn't necessarily make it true because the readings that we see have been clean all the way through. ETH pulling back a bit more dramatically because it had a little bit of an outside move trying to catch up to relative strength in Bitcoin. But it's gotten a little excessive here, and at the 50%, though, you still have MBI white leading now in a clear range, so that puts that 50% under a lot of pressure for ETH standpoint. From 50K, all pretty clean from the beginning of the breakout move, midway through, early part of the day. Finally closed it out, and we just consolidated from there. And that's usually typically what happens when you get that kind of extreme move of the steel below negative 13.5, and then you get another upspurt as soon as it comes out of it. The key here is that you will have to get shakeout matching, otherwise you're going to end up with matching higher highs and a lower shakeout reading, and that will be the signal for a little bit of a pullback into a negative zone. What we can see is we had the big burst at the start of, right before the open, and then as soon as the open actually happened, we ended up fading and based off pretty well, and modest wasn't anything to speak of, and we're sort of in that same zone at this particular stage. So all pretty clean. I think that again, the macro situation is starting to grow. We see the issues of Middle East and the China meltdown. The question will be, will that start to bleed over? I know there's been a lot of insulation since the last breakdown that the Chinese stock market has had, so it's not correlating as strong as like when we had Evergreen in that kind of situation. But it's still the potential for contagion there, as you have potential liquidity drain for the market, and whether that will be significant enough to have any impact at this particular stage, not really having much consequence, at least for the U.S. markets, but definitely something to watch because if the Asian contagion, as they called it before, spreads like it did in the 90s, and that can really create some difficult situations. So we'll keep an eye on it. But for now, we just follow the readings. As always, though, anything relevant, I will put it on the Skype chat. Have a good one. Trade well.